Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I actually wanted to have him back on for an oil market update because in the last 2 months, we've had an absolutely enormous rally in U.S. oil prices, I think around 30%. He's oil hedge fund manager of publicly traded companies at Bison Interest, Josh Young. Thank you for joining me again.
Yeah, hey Jason, thanks for having me back on.
So, Josh, we're recording this interview on Friday, September 1st, 2023. We have, just like I said, an absolutely enormous rally in oil prices the last about 2 months. The West Texas Intermediate crude oil price is almost to $86 a barrel again. Brent crude's almost to 89 at $88.91. Natural gas has even rallied substantially the last couple months, up from 220 up to almost 280. Want to get your thoughts, though, before we start talking maybe about supply and demand dynamics with the oil market, on the Fed interest rate hikes and how you think all of these Fed interest rate hikes, the record pace the last 12 plus months, are affecting oil and natural gas producers.
Sure. So just real simply, I'm a University of Chicago trained economist, and so I am a little biased, very heavily in favor of Milton Friedman, who won a Nobel Prize in economics a while back, and was actually one of many Chicago School economists who won the Nobel Prize and had sort of a theory around monetary policy. And their theory was, and I think Milton Friedman came up with this, that there's a long and variable lag on monetary policy. And so it's very odd to hear the Fed chairman say those words and then ignore them. And so there's a really simple approach to monetary policy that Milton Friedman dictates, which includes not radically shifting it over short periods of time because it takes a while for it to play out. So I think the Fed is sort of failing that very, very basic test of not making radical shifts, and has made radical shifts in both directions multiple times over the last 5 years or so. And so I think we're just sort of experiencing another one of these policy failures by the Fed by doing these sort of rapid whiplashy shifts. For oil, the way that this is playing out is higher interest rates discourage investment. And so higher interest rates are actually, over the medium to long term, they actually create higher oil prices, not lower. But they also have many other effects. They decelerate the economy, but they decelerate investment, and that yields higher prices, not lower. It's sort of a misconception that higher interest rates lead to lower oil prices over time.
Yeah, I totally agree. Especially with the demand numbers that we're seeing out of the U.S. I know you've been tweeting about these for the last month or so, with Valero releasing the gasoline demand and the surprise amount of demand we've seen, demand growth globally. I think we had record oil demand globally, despite China not picking up and coming back online very quickly. There's been a lot of demand growth for emerging markets in non-China markets, I think India and many other emerging markets. And this is not coming from the American crowd that buys sport utility vehicles. These are people that are buying motorcycles, scooters, those types of things, and they're consuming gasoline and diesel.
Yeah, I mean, honestly, I was thinking about this ahead of this interview. You and I have spoken at points where oil sentiment is very low, and at times where sentiment and price are very high. And the reality is that I don't think very much has actually changed, in the sense that we've sort of been in this undersupply environment where there's been underinvestment for years. And there was a brief moment last year where oil rigs, there had been over 100 rigs added, and onshore US, and we were starting to see a pickup in international activity. And there was a shot that the oil market would actually get closer to adequately supplied over a multi-year period if that trajectory held. But then with the SPR release and with concerns around demand in China and various other places, we saw that rig count, I think, is down over 100 rigs between oil and gas onshore US. With that rig count falling, we sort of lost the shot at that. But otherwise, I mean, frankly, over the last couple of years, there's various aspects of the story that have changed, but just the longer term perspective of insufficient investment leading to undersupply, has held up. And so it's sort of always interesting, I think, to think about what's the narrative of the day. And we shifted from a couple months ago where everyone was worried about a recession. And we put out actually a couple of different white papers around recession fears and why we thought it made sense to maintain exposure to value priced oil and gas equities despite recession fears. And so far, I think that's proving out to be correct. But both because the stocks have been cheap and have done well, and also because oil prices, while they've been volatile, have not collapsed as a number of different sort of self-proclaimed macro experts, but not oil industry experts, had forecast.
Well, didn't like 4 to 6 months ago, there was a record amount of oil futures contracts that were short. And you had the Saudi oil minister that was warning about, he thought there was paper price manipulation with the oil futures contracts short. And then around March or April, I think you were on, and the Saudis had just announced a voluntary production cut. But then I think Russia followed. They're implementing, the Saudis are maintaining their production cut, I think 1 million barrels per day approximately. And then Russia also announced recently that they're going to be cutting production, 300,000 barrels per day. So even though the oil prices are higher than they were a month ago, we've had a substantial rally the last 2 months. There's not a lot of new supply coming online because the rig count, Josh, I think I just checked it today on Y charts, since the November 2022 highs, which is the most recent highs for the rig count, we're down about 20% now here in the US for the rig count.
Yeah, that's right. The rig count's down. That was what I was referencing. And yeah, I think it's just a really interesting macro situation. But again, it's just I don't think the fundamentals of the physical oil market have really changed that much. And China's reopening, like you referenced, took a little longer than I thought it would, but it's also been a lot more steady than I would have expected. And demand in China it's more steadily increased. And it's been very interesting. I guess one of the narratives in the last couple of months is that there's been all these news headlines that China is imploding. And the reality is that when you look at the actual physical data, China hasn't had the same economic level of activity that they've said. And I guess it shouldn't be surprising to anyone that China's been sort of fudging their numbers. But when you look at their real consumption and real activity versus their stated, the real activity in the last year has actually grown quite a bit, even though the stated activity is down. And so you have this sort of weird thing where you have headlines blaring, China imploding, China in trouble, and you're actually seeing real-time indicators and real-time consumption patterns that are constructive and that are higher on a seasonally adjusted basis. So it's been very interesting sort of navigating through these narratives. And I think just my simple takeaway from all this is, one, the oil and gas equities are still very cheap. And so I like them because the value is there on a mid-cycle basis, and they have very little debt, which makes them very different from what they were like in the last few oil cycles or last few sort of mini cycles where they were very sensitive to commodity price movements. Now they should be less sensitive on the downside because they have less debt. But more importantly, whenever there's sort of a negative economic headline, the first thing it seems like funds do is go and short oil. And so even though oil has actually been pretty resilient from a demand perspective, and we're in an undersupplied market, which was consensus. And I mean, it should be no surprise. It wasn't a week or a month that I was tweeting that. It's been a year. I mean, it's just been sort of obvious that there was going to be this big deficit. And yeah, OPEC is cutting a little more, but that just sort of exacerbated the deficit and made up for some of the SPR releases and some of the other issues like Iran bringing on more production and so on. So I think it's sort of this like really interesting thing where people hate it, and so they're ready to sort of short it, ready to talk about how it's going to crash. And I think that actually makes me like it a little more because the sentiment's so negative, everyone piles on it. And again, I just think that means that very few people own it, or that there's maybe a lot more of a wall of worry to climb for oil price, as we've seen already in the last couple of months.
And also the anti-fossil fuel bias that a lot of these money managers now have, banks now have, because they have pro ESG policies. There's a lot of institutional investors and banks that just can't invest or buy conventional energy related plays. Maybe they can buy some LNG shares, some liquefied natural gas companies, but they can't buy coal. They can't buy oil. They can't buy the conventional plays of energy. And I think that's going to restrict the supply side, the investments in the supply side, along with these higher interest rates, Josh. So what we're seeing in the Permian Basin with the shale wells recently, and this is probably because a lot of institutional investors or people who have millions of dollars in cash are looking at things at a higher interest rate and saying, why am I risking funding a shale well right now that has a high depletion rate when I can go earn quote unquote a risk-free rate with US treasuries or money market funds close to 5%. So I think the capital that was available for, even though oil prices have rallied, the capital that was available for a lot of these private shale drillers is not available for ESG policies that are anti-fossil fuel. And then also because of the interest rate narrative that we discussed earlier. And do you think that's why these private shale companies are selling so much of their assets and their producing wells to the low cost Permian Basin producers like EOG, Pioneer, Sandridge, and those guys?
Yeah, I mean, there's a lot there. I think there's multiple factors for less investment, and one of them certainly is higher rates. That certainly is suppressing investment across the oil and gas value chain. But there's also been this consolidation trend, which we've put out a number of different white papers and updates and so on consolidation in the Permian Basin and in the Western Canadian Sedimentary Basin and elsewhere. And that consolidation trend is pretty powerful in the sense that it's generally been publicly traded companies buying generally privately held companies and reducing the number of rigs that are active on the assets that they're acquiring. So taking companies that are growing, let's say 20% a year, buying them and shifting from 20% a year growth to keeping production flat, or in some cases, even allowing production to fall off to some extent. So that consolidation trend has actually been pretty powerful. I'd say there's probably 20 or so rigs that aren't running in West Texas and Southeast New Mexico that would have been running absent this consolidation trend, or that you can attribute dropping because of those sort of mergers. And I think as that trend continues, we're going to continue to see sort of more rational investment behavior by the remaining consolidated industry or increasingly consolidated industry. And I think that's very price constructive as well as valuation constructive for those survivor companies.
So, for example, then, do you think that EOG is buying those assets because I think they did a deal in the last 3 or 4 months because their cost of capital is cheaper then?
EOG is a little complicated. They did an acquisition in the Utica Shale in Ohio, and that one was a little different because it was basically more of a land purchase than a purchase of producing assets. EOG is sort of an exception; they're still growing organically. But when you look sort of across the rest of their competitors and that sort of peer set, as well as looking at larger producers and oil majors doing acquisitions and mergers, as well as sort of on the smaller side, almost all the other deals you are seeing this sort of behavior. So, again, EOG in particular, an exception to this, I'd say. But this general trend has held, and it's one of those things where, in general, I think it's great for the industry, and generally has been great for the companies. So Permian Resources is buying Earthstone. That was a deal that was announced recently, and it's wonderful. It's a share for share deal. I'm not involved in either company, but it's just good to see. I think there'll be some more sort of production rationalization from that. There's other deals that I think are much less good, and that in some cases are sort of predatory, where you have private companies that sort of take advantage of poor governance by public companies. There's one in Canada that I own shares in that I'm opposing that deal, or at least people can vote however they want. I'm not recommending how they vote, but I'm voting against that particular deal, and I bought stock in it, and I'm voting against it, where it's just it's not like these other sorts of consolidation. And so I think people were a little confused. Hey, don't you think it's great for there to be consolidation? And the answer is yes, but I think it needs to be a sort of win-win deal. And when you announce a deal and the acquired company's stock goes down 20%, that tells you maybe it's not such a great deal. Versus, you look at the Earthstone thing, and Earthstone agrees to sell. Their stock, I think, was up 10% the first day. Permian Resources issued, they increased their share count dramatically, and the stock only fell on that announcement by 1 or 2%. And then within a few days, it was back towards all-time highs. So I think you want to see stuff like that. I think most of these deals are pretty healthy. There are reasonable valuations that are being paid. It ends up being good for the industry, but there are these individual deals that are the exception. And whether or not I'm involved, I think generally it's important for the health of the industry for there not to be these sorts of deals that take advantage of bad public company governance and sort of essentially rob the passive minority shareholders for the benefit of either large institutional shareholders or private equity-backed companies.
Yeah, it depends on the terms of the deal. So not all consolidation is good. I think it came out like Chevron or one of the other larger medium-sized oil companies was paying insiders. They were going to take out all the insider stock options that weren't in the money on one of the deals a number of years ago, and then it got leaked. So there's always like these sweetheart deals for the management of some of these smaller companies. It happens in the resource industry, unfortunately, more often. I was in a company years ago, a small company, and I thought they were taken out for way lower than their valuation should have been, and management had all their stock options bought out that were way out of the money.
Yeah, I think it's complicated. Um, there are aspects of this where you actually, as a passive minority shareholder, want the management team to be well compensated in a transaction, but not too much. And so, what you're describing, I think that's one of those areas where sometimes options get adjusted right before a deal's announced. I think that was the Anadarko deal that you're referencing, where Chevron was going to buy Anadarko, and Anadarko was agreeing to a relatively low price. But their management was getting to reset their options at a really high price. They changed their compensation arrangement the day before the deal was announced. Oxy ended up actually outbidding Chevron, getting stuck with this high bill on the executive compensation and paying a sort of fair value for Anadarko shares. So that ended up working out, I think, okay for the shareholders. But yeah, that's the sort of thing I think it just leaves a bad flavor in the mouth of investors, and I think it just hurts the industry. And I think when people do that, obviously the individuals involved end up earning excess returns, but I think some of the private equity funds that do this repeatedly, I think they end up hurting themselves and reducing their ability to exit. And you'll catch them sometimes complaining about how there's not as much of a market for their companies, or how they're not able to transact at valuations like they used to. And the reality is that some of that's sort of their own fault. If they were a little more reasonable and a little more inclined towards win-win sort of deals, I think you'd see sort of a healthier market, higher valuations, and sort of over time, it's from a game theoretic perspective, over repeat transactions. I think if you behave well, you can actually do better than if you try to cheat or sort of get that extra little bit that makes it unfair and sort of hurts one side of the transaction.
Yeah, that was the deal I was referring to, was Anadarko. And Chevron also walked away with $1 billion exit fee because they didn't win the bid. So because they were negotiating, I think Chevron got $1 billion payout from Occidental Petroleum and Warren Buffett, who helped finance that deal.
Yeah, I think that was one of those really interesting things. I think that dramatically improved my view of Mike Wirth, the CEO at Chevron. I think he was the CEO then too, and I think it really showed. When you look at the very large amount of dilution that Oxy had to do during COVID after levering up to do that transaction, you got to see the value of Chevron's prudence and their unwillingness to engage in a bidding war, especially after that sort of compensation arrangement, which made that deal more expensive and also less palatable to the shareholders of the selling company. So yeah, I think it's one of those things. You look at what Chevron's done in terms of buying PDC recently and buying Noble during the downturn versus what Oxy did, where they levered up to buy Anadarko and then had to issue a ton of stock and engage in a lot of dilution during the COVID downturn. I think one of those is clearly the winner in terms of shareholder value creation through M&A, and the other is clearly has sort of hurt their shareholders through their consolidation activity.
So these acquisitions that are occurring in the Permian Basin and Canada, you don't expect a lot of production growth with these wells. You don't expect the producers of publicly traded companies that are buying these assets to invest a lot of capex to rapidly grow the wells, even though we've had a rally in oil prices. You think then that maybe then they're just replacing quality acreage that they've already had depleted, and they're going to wait for higher oil prices or interest rates to come down. They're not going to be very quick to start adding production growth from new wells.
Yeah, well, it's less about what I think will happen and more just observing what has happened over the last, let's say, 2.5 years, where as public companies have been buying private companies, for the most part, Permian Resources is buying Earthstone, which is a public company, but it's mostly been, and that was something that I forecast that I got a lot of pushback on. People said, "Oh no, like the small public companies aren't going to get it bought out, and they're certainly not going to get bought out for premiums." And here you go, Earthstone bought for a premium. The stock had done quite well this year prior to that announcement, with some volatility, but it had done well. So it wasn't like it was getting picked off at some very low share price relative to recent share prices. It wasn't getting picked off for that low valuation. I mean, it wasn't a great valuation, but it wasn't. It was clearly a win-win deal. Again, you could see sort of through the share price performance of both companies involved that it was. I mean, it was perfect, right? It was like what you wanted to see for that sort of deal. And so, I think when you look at what's actually happened and the number of rigs that have dropped on assets that have been acquired, you see what I'm talking about. So, what will happen in the future? I think likely more of the same. Why do I think that? Both because it's rational and because the companies have already been doing it.
Well, where do you think the oil production growth over the next 5 or 10 years is going to come from globally then?
Yeah, so I think that's part of what's motivating these deals is not just, it's not, I think, altruism by the companies that are acquiring in terms of cutting supply. That's more just pragmatism. I think the challenge is to either get bigger in shale and sort of build out your multi-decade inventory because there's not really new plays that are getting discovered. EOG is active in the Utica, but there have been very mixed results on the oil side of the Utica. Maybe EOG will fully crack it. Maybe they've just found a few sweet spots there. Similar challenge across various other potentially emerging oil shale plays where they haven't been quite as economic or productive or both as people thought. And so I think you need to go offshore and international. And when you look at the offshore rig markets and you look at international activity, I think you see stuff in the Vaca Muerta. You see if they ever get their act together politically, Iraq has a number of oil fields that could get developed, and various places in West Africa, East Coast off of South America, and then various spots in Southeast Asia. So I think you see offshore. I think you see onshore international in certain spots, and I think it's going to be really hard to actually get the level of production growth that's necessary to meet likely world oil demand absent a severe international economic downturn. And so I think it's going to be a really interesting and really tough scenario. And the consultants that go and model all this stuff out in detail, project by project, and so on, like when you look at their work and you look at the assumptions that are necessary to not have a severe oil crunch, insufficient supply relative to demand on a multi-year basis, I mean, you really have to engage in some heroic assumptions in terms of production growth in those various spots, as well as assuming very little geopolitical related oil supply disruption, which is just a bad assumption historically. If you look through over the last 20 years, 30 years, 40 years, I mean, just as you go back, you can just find more and more of these disruptions. And we're actually in sort of a weird state where even with the Russian invasion of Ukraine, we actually are in a fairly calm. I guess there have been a couple of coups and stuff in Africa, but even those haven't really disrupted the oil supply. And even Russia's invasion of Ukraine, people thought it would, but didn't quite disrupt the supply. So we're in a very oddly sort of stable period from a geopolitical supply of oil perspective. So there's a lot of risk, I think, to the downside from a supply perspective, just if we got back to sort of the normal, let's say, 2-ish million barrels a day of supply disruption relative to total global production capacity.
Isn't the inventory of drilled but uncompleted wells in the Permian Basin? I know that I think around 2020, got to almost 4,000. So there was a lot of wells that could have been brought online quickly, in about 6 weeks approximately. So those are wells that are already drilled but uncompleted DUCs, and those could have been brought online quickly. Hasn't that inventory been entirely depleted? And over the next couple quarters, haven't the oil service companies been saying on their earnings calls that there's not a lot of drilling activity? So there's not the ability for a lot of these Permian producers to bring on those drilled uncompleted wells quickly anyway, because the drillers aren't getting the business that they were in the past.
Yeah, but I mean, to be fair, I think that's a little bit of an old story. So that was something that was becoming an issue at the start of 2022. We put out a white paper, I think January of 2022. By mid-year 2022, it became sort of a three-alarm issue where there was going to need to be a lot more rigs added in order to sort of sustain production growth trajectories that the industry had been on previously. That's where you saw that rig count rising last year. And then now that it's come down, I guess it is really relevant to talk about it again, because now that we've seen that drop in the rig count, we're sort of in this spot where I think people intuitively think, hey, the industry can show production growth because it did around this rig level a year and a half ago. And the problem is that the industry did that while burning through a few hundred, I think it worked out to be about 200 drilled uncompleted wells a month that were getting worked through at that point. And it varied. There were months where it was more, and there were months where it was less. But as we're closer to sort of zero excess drilled uncompleted wells, you always have some because they're sort of working capital. You sort of need them if you're going to go drill, let's say, 20 wells on a pad and then complete all of them. And when you're halfway through, let's say you're halfway through all of those projects, on average, you're going to have 10 DUCs per pad that's in progress. And some might have 19 DUCs and some might have one. But if you just think about development activity in those terms, you're going to have some number of, and maybe some pads will have 5 wells, so you'll have 2 DUCs on average or whatever. But you're going to have some just for normal activity levels. So without excess DUCs to burn through or work your way through in order to add excess supply beyond what you're drilling for at a given point, you really need more rigs active. That rig count becomes more meaningful in terms of incremental or I guess marginal supply in either direction. And so I think you will need more rigs running. And you're starting to see it actually in the commentary from the drilling rig companies as well as from the pressure pumping companies. I think they're expecting a pretty big uptick in the rig count going into Q4. And I think there's a risk of disappointment there. Absent oil prices, I guess oil being at 85 or so as we're doing this is helpful for that. I mean, it certainly wasn't helpful when oil was $20 a barrel lower, but with higher interest rates, I think there's a lot of pressure on those plans to bring on additional drilling rigs, and I think we might need even higher prices to start getting activity levels back to sort of more healthy and sustainable levels versus where they are now.
The near-term oil production growth, Josh, the area I'm optimistic about seems to be offshore Guyana with ExxonMobil and Hess Oil. So those well, and then also Petrobras. So those areas seem to be relatively low-cost wells. Those were very unproven wells, especially for Petrobras in Brazil many years ago. Now they're proven. They have some really low-cost wells with low depletion rates, and now ExxonMobil and Hess seem to have a lot of near-term production growth at fairly low cost.
Yeah, that's true, but I think it's important to keep that in context. For every Guyana, there's 3 or 5 different countries or sort of sub basins where there's not that reinvestment and where there's production declines rather than production growth. So Guyana on its own is obviously growing oil production quite a bit, hundreds of thousands of barrels a day every year, and on track to do that for multiple years. The problem is, from a adequate supply perspective, that Guyana is replacing production declines in, let's say, West Africa, and there's maybe not enough drilling activity in West Africa to offset to offset the declines there and production growth in Guyana, for example. And so there's just not quite enough activity. And Petrobras, maybe they'll grow like you're saying and they're saying, but Petrobras has a reality. Paul Sankey, a famous independent oil analyst who was I think UBS oil analyst for a while. I think that was where I met him. he has this great chart that he's shown where if you look back at Petrobras growth forecasts over the last, I think it was a chart he put out like 8 years ago or 7 years ago, and you could look at their forecast for every year, and they would project growth, and then it would every year they'd be projecting, let's say, 300,000 or 400,000 barrels a day of production growth, and they'd end the year at the same level as they ended the prior year. So maybe this time is different, and I am a little optimistic that they'll grow a little, but I'm certainly cautious around the amount that they'll be able to accomplish relative to their guidance, considering their many years of big promises and disappointment. And again, it's a national oil company in a country that elected a leftist president, who's been intervening in the operations of that company, which is a essentially state majority owned and controlled enterprise, and has been intervening in a number of ways that I would expect to mostly be negative, not positive over time for shareholder value.
As we wrap up the interview, do you think that the Strategic Petroleum Reserve sales, so there's not going to be any major mass sales going forward, or do you still think that there's going to be a downtrend in the Strategic Petroleum Reserve, a substantial one?
Yeah, I would expect. I mean, the joke was on the giant draw from the SPR, where it fell by about 50% around the midterm elections in the US. The joke was that it was the midterm petroleum reserve. So I would expect another large draw from the SPR going into the next election. I don't know when it will start. Maybe it'll start 6 months ahead of the election. There's been a lot of challenges with US economic data. Unfortunately, sort of going the way of China, where there have been a number of economic reports that have been subsequently significantly revised, and a lot of interventions in the economy and interventions through, some of it's just statistics, some of it's like the SPR withdrawal ahead of the election, that have been sort of, it looks like, politically motivated and have been sort of unusual relative to those sorts of the approach that the US has taken towards its economy, where historically it had been more oriented towards sustainable growth. And these intervention measures recently have been more oriented around re-election of certain political leaders. And so I would expect, based on those recent actions, for there to be another significant draw from the Strategic Petroleum Reserve. That being said, we're in a supply deficit that's pretty severe, and we haven't seen that rig count rise. And so without the rig count up another 100 or so rigs, and without seeing either more of an economic slowdown or more sort of surprise oil production from somewhere, I think even if we have an SPR withdrawal, I don't think it's going to impair oil prices beyond sort of the short term, immediately around when the oil is withdrawn.
Yeah, I agree. I think we're going to stay range bound for a while, depending upon economic factors. We could be in a fairly wide trading range, but I agreed with the research report, and I know you sent me it from Rystad that they put out about a month ago, or a little over a month ago, that was actually predicting that oil prices, when they were, I think, in the low 60s about 6 weeks ago, would rally back up to around $90 a barrel because of the supply side problems, and demand globally was actually much stronger than anticipated.
Yeah, I think I probably forwarded that to you from Twitter. I think someone posted it. I'm not a subscriber to that particular consulting firm's work, but yeah, I think it's been really interesting. I think my favorite external report I've read in a while was from Morgan Stanley, and incidentally, it was a bearish oil report, and it came out a couple months ago, and in it showed the bimodal price tendency for oil, where you either have oil prices clustered around a demand destruction point or a supply destruction point, where if oil prices are too low, on average you end up sort of tending towards insufficient reinvestment relative to demand growth, and so that would be the supply destruction point. And then if oil prices are high, which is the other place where prices tend to cluster over time, you have prices high enough that they encourage a lot of additional supply and discourage additional demand. And so I think when you think about that, it becomes clear why there's such sort of fierce battles between oil bulls and oil bears, because you sort of need oil to be, there's just a tendency for the price to be in one of those two areas and not to be what we've seen very recently, where we're sort of in the middle between supply destruction price area and demand destruction price area. And I think what we're seeing right now is a shift out of the um, out of the supply destruction price area, and really, like, I think when you think about it sort of simplistically, and I've been thinking about this in terms of communicating this with my clients and with others just more succinctly, in supply destruction price environments with value priced equities that are, well run and whatever, that's probably a good signal to be investing. And at demand destruction price points, especially at higher valuations, that's probably a good market signal to be selling or divesting. And so, there's been this just incredible opportunity recently. I think it's still there to go and buy just very inexpensive oil and gas stocks. In many cases, the companies are very well run. The stocks trade at a large discount to the likely liquidation value of their assets. There are active buyers of those assets. And so, none of this is a recommendation for anyone or a solicitation for my business, but it's just been this great opportunity. And I feel like we still have that to some extent, but I think there's a risk that we move pretty fast. And like we saw last year and in 2021, there's the chance when you own things that are very undervalued and where there's a large price move in the underlying, there's a real possibility of significant moves in share prices over relatively short periods of time. And again, my crystal ball is broken, but it does look like, to the extent that we have these sorts of supply deficits continuing, that we may shift into that higher price environment, that more sort of demand destruction mode from oil pricing perspective, that it may be a little sticky, and that at that point we may see significant valuation moves up in the sort of smaller, off the run, much lower valuation producer and services equities.
Did you also see the chart that came out from the International Monetary Fund, the IMF, that came out recently, that fossil fuel subsidies actually hit a record $7 trillion in 2022? So I was shocked to see that despite the anti-fossil fuel stuff being spouted everywhere in the mainstream media and on social media, despite the pro ESG stuff, the fossil fuel subsidies to fuel demand still hit 7 trillion in 2022, a record.
Yeah, that was very flawed. I mean, I look, when I'm looking for sort of insight, I try to track records. And so, if it's a fund manager pitching a stock, I try to find their fund performance over time to try to calibrate. It's an easy starting point for calibration of credibility with sell side analysts or sort of macro forecasters. I try to look at their track record of predictions. There's some famous doom predicting commenters that get on TV or sell books or whatever, who have just they forecast 20 out of the last two recessions, or folks like that. And so, it's helpful to calibrate. And then for the IMF, look, for them, it's really interesting because you can look at their interventions historically, and they're just absolutely abysmal track record of repairing economies. Frequently they'll give advice and they'll sort of force countries to do certain things, and their advice ends up yielding very bad outcomes versus their non-involvement in other similar situations. So I would point to that and as sort of a calibration. And again, I really encourage engaging in this sort of calibration. It's a great heuristic. Again, it doesn't, just because someone's done well doesn't mean they're always right, but they're more often right than someone that's done very poorly. And the IMF in this case, they conflated two things. Those subsidies are actually extremely low, especially when compared to alternative energy. The thing that they were weighting very heavily, which was, again, it was sort of nonsensical, was the externalities around CO2 emissions, and totally inappropriate. That's its own whole conversation. I'd point folks to Alex Epstein's work and various others that I think do a much more credible job of evaluating the costs and benefits of that. And, the IMF work just completely ignored the benefits and just focused on the costs. And when you look at a cost benefit analysis and just do that, of course, you're going to end up with a giant cost. So the actual subsidies are radically lower than they showed. And again, don't believe anything I said. Just look at their track record. It's not hard to find, and attribute credibility, I think, in line with that track record.
Well, I really enjoyed our conversation today, Josh. I want to thank you for coming on for an update. Do you expect oil prices then to potentially stay range bound then between bulls and bears because of what the global economic factors and people are worrying about a recession or Fed raising interest rates further, or other central banks raising rates further?
No, I actually think oil prices will be extremely volatile as we go back and forth between demand destruction pricing and supply destruction pricing. I think if we see significant sustained deficits, we may end up being sticky in demand destruction pricing, and we may test the upper limits of that. But that may also sort of destabilize the global economy and end up yielding a sort of maybe a catalyst for a potential recession. But again, my crystal ball is broken. I really don't know what'll happen in the short term. What I do know is that underinvestment over a multi-year period is yielding these supply deficits, and that it seems likely, absent a severe global recession, that will be in a supply deficit scenario most of the time going forward over the next few years, especially until we see substantial additional investment in global supply capacity for oil.
Is that similar to what happened with the price spike in 2007 then? Because back then we didn't have the shale oil bubble and a lot of shale production, but now it looks like we're going to have some substantial depletion from shale wells. And it looks like much higher cost deep water production is going to have to offset the depletion from the shale.
Yeah, I think it's similar in a few regards, but it's also different in one key regard. 2008 happened many years into the oil bull market, and there had been a large new build cycle for rigs, both onshore and offshore. There was a way more rig activity, just way more. What was like the rig count was 2,000 or something in the U.S. versus now it's close to, I think, 500 or so for oil. And again, there's differences in the technology and so on, but also the difficulty of getting oil was lower, and wells were more productive on a, let's say a 1 year basis with lower depletion rates and so on. So just more conventional rock, more productive. So I think the biggest difference is just we're not that far into this oil bull market, and so there hasn't been the same sort of capital cycle that we saw for oil by 2008. And so when you think about sort of what that means, supply wise, I think 2008 there was something like 3 million barrels a day of supply growth, and we're not anywhere close to that. And the big disappointment was that global demand fell a little relative to expectations in 2008. I think we could stomach more of a demand fall in the current environment, just given the supply deficit and the difference in the capital cycle. But I think I have to wrap it up here.
Yeah, and we can also see the Saudis and Russia continue to maybe do cuts. It seems they kind of want a Goldilocks oil price. They do not want oil prices at $65 a barrel or lower.
Yeah. And again, like OPEC running out of spare capacity, there are various other considerations here. Iran having almost all their spare production on and supplying the market. Venezuela ramped back up to some extent. These are all factors that actually limit the ability of incremental supply to adequately supply the market.